Cisco just caught Wall Street's attention. AI infrastructure orders are climbing, margins look stronger than expected, and analysts are suddenly talking about a new growth cycle for a company many people thought was already past its prime. Today, we're digging into whether Cisco is quietly becoming an AI infrastructure winner, or if the recent rally is already pricing in too much. Hi, I'm Emily Carter. Let's jump in. Cisco may not be the flashiest tech company, but it's literally the backbone of the world's networks. Think routers, switches, cybersecurity tools, and collaboration platforms like Webex. All the essential stuff that keeps businesses running. And what's more interesting is how the company is shifting away from being a traditional hardware vendor. Cisco is pushing heavily into software and recurring subscriptions, and that transition is shaping the entire future of the business. For years, Cisco was seen as a slow-moving, mature tech giant. But that picture is starting to change. Wall Street now believes Cisco is entering a second growth phase, mostly because software and subscriptions make up more than 50% of its revenue. That means more predictable cash flow, better margins, and stronger long-term visibility. It's one of the main reasons major banks have become more optimistic about the stock. The real excitement around Cisco comes from AI, and not the chip side we always hear about. AI models need huge amounts of networking power, faster routing, ultra-low latency switching, stronger security, and more bandwidth than ever before. Cisco recently revealed that hyperscalers have already placed billions of dollars in AI-related orders for the next couple of years. This is the strongest demand they've seen in a long time, and it could redefine Cisco's growth story. Before we go further, let's talk about what Cisco is actually building right now, because these ongoing projects tell us exactly where the company's future is heading. Cisco is currently deploying its Silicon One-based networking upgrades across large AI data centers. These high-performance switches are specifically designed for massive AI training clusters, and several multi-year deployment contracts are already underway. At the same time, Cisco is integrating Splunk into its security and observability portfolio to create a unified, AI-driven security platform. This is one of Cisco's biggest strategic projects, and new capabilities are being rolled out to enterprise clients month after month. And finally, Cisco continues to upgrade Webex with AI features like real-time translation, automatic meeting summaries, and more advanced cloud calling. It may not grab headlines like AI chips do, but it's still a core tool for global enterprise communication. Altogether, these projects show Cisco isn't just selling hardware, it's building the infrastructure and intelligence layers that the AI era will run on. One thing that sets Cisco apart is its financial stability. Revenue sits around $56 billion, profits are solid at nearly $10 billion, and margins are healthy across the board. Debt levels are comfortably low, and free cash flow is strong enough to support dividends, buybacks, and ongoing investments. This is exactly why big institutional investors love Cisco. It's reliable and far less volatile than many high-growth tech names. Still, this isn't a risk-free story. Cisco's legacy hardware business is slowing, and competition in networking has never been tougher. On top of that, short-term liquidity ratios aren't perfect, which means the company could feel pressure during a macro slowdown. Cisco offers stability, yes, but it's not the kind of stock that shoots up 50% overnight. At the current price levels, Cisco trades at about 17 to 18 times forward earnings. That's cheaper than most major tech giants, but not exactly a bargain compared to its own history. Analysts generally see the stock heading toward the mid-70s, which suggests moderate but steady upside. Cisco is the definition of a performer that compounds quietly, not dramatically. Now let's look at Cisco from a shorter-term trader-focused perspective, how the stock could actually behave over the next 12 months. Cisco isn't known for explosive rallies, but it does react sharply to earnings, AI order announcements, and macro data. In a short-term bullish setup, strong earnings and continued AI order commentary could push the stock toward the $80 to $83 range, especially if large funds rotate back into value-oriented tech. In a neutral scenario, Cisco likely stays in a tight $72 to $78 channel, moving sideways as investors wait for clearer signs of AI-driven revenue acceleration. This is usually where the stock spends most of its time: slow, steady, and controlled. And in a bearish short-term case, softer enterprise spending or weak guidance could pull the stock back towards $62 to $66, which historically acts as a strong support zone and a popular accumulation level for long-term investors. So in the next 12 months, Cisco is more of a range trading opportunity than a breakout story, unless AI demand surprises to the upside. Now let's zoom out a little further and look at where Cisco's stock could realistically stand over the next few years, not just the next 12 months. In an optimistic long-term scenario, Cisco fully capitalizes on AI infrastructure demand. Its Silicon One platform becomes a standard in hyperscale data centers, and the Splunk integration strengthens its security ecosystem. If this plays out, Cisco could trade in the upper 80s to low 90s, especially if margins expand. In the base case scenario, the company grows steadily, but without spectacular acceleration. AI helps, subscriptions keep increasing, and revenue remains healthy. In this case, Cisco likely stays in the mid-70s to low 80s range, slow, steady compounding. And in a pessimistic case, AI orders slow down, enterprise spending softens, or competitors gain ground in networking and security. If these risks materialize, Cisco could drift back into the low 60s, which has historically acted as a strong support zone. These ranges aren't predictions. They're guardrails to help investors understand the road ahead. My honest take: Cisco is a stable, dividend-friendly tech stock with a surprisingly meaningful AI angle. If you're after explosive, high-octane growth, this won't scratch that itch. But if you want reliable performance with lower volatility and long-term relevance, Cisco is a name worth paying attention to. And that wraps up the full Cisco breakdown. If you want me to cover another AI infrastructure stock or compare Cisco to its biggest competitors, just drop the ticker in the comments. And if you enjoy deep, calm, no-hype market breakdowns, make sure to check out my other videos. See you in the next one.